Hey everyone, thanks so much for checking out the video. My name's Mike Stokes, and on this channel we talk about all things entrepreneurship, tech and venture investment. So if you're interested in those areas, please hit subscribe. In this video, we're talking about how venture capital investors find the best startups to invest in. Or in other words, we're talking about how VCs generate what's known as deal flow, a flow of investment opportunities. Now I'm stating the obvious, but securing high quality deal flow is fundamental if a VC investor wants to be successful in the market and generate outsized returns for their LP investors. So in this video, I'm going to be talking through exactly how they do it. Let's go. Okay, so I'm going to split the different sources of deal flow into two broad buckets. Firstly, inbound deal flow, and secondly, outbound deal flow. Inbound deal flow is where the investment opportunity finds the VC, it comes into them, whereas outbound deal flow is where the VC finds the investment opportunity. So let's start with inbound deal flow. The first source of inbound deal flow that I'm going to talk about is network referrals. So in short, this is where other people in a VC's network recommend them to check out an investment opportunity. Now, in my experience, this source of deal flow is the most valuable and the most important for a VC investor. Now, ideally, these investment opportunities are coming to you from people that you trust in your network, and even better, they're being sent to you before anyone else sees them. But who is it within a VC's network that is likely to send the best deal flow? In my experience, it's two groups of people. Firstly, other VC investors, and secondly, entrepreneurs. So deals that come from other VC investors could work in a number of different ways. Firstly, it could be a VC that's wanting you to co-invest in the current round with them. The second way is that it might be a VC investor that focuses on an earlier stage, maybe seed stage, whereas you focus on Series A, and they have already invested in a company at seed, and they're therefore recommending that company to you to consider for investment at Series A. So that way they're basically making connections for their portfolio companies and helping them to raise more capital. But how do deals actually get shared between different VC investors? I've seen this happening in a ton of different ways. It could be formal monthly deal flow updates, it could be WhatsApp groups sharing deals on there, but more often than not, in my experience, it's coffees and a lot of breakfast meetings. I always thought the breakfast meetings were kind of random, but turns out they're great for sharing deal flow, and they're also pretty tasty. Okay, so the second group of people in a VC's network that sends them deals are other entrepreneurs. More often than not, these are entrepreneurs who are part of that VC's existing portfolio of investments. I think it's really important here for VCs to recognize that entrepreneurs are often experts in the areas that they focus on. And so if an entrepreneur is recommending that you check out a deal in an area that they know about, I think is a good idea for the VC to listen. Okay, so the second source of inbound deal flow that I want to talk about is emails sent directly from founders to the VC, asking them to consider their company for an investment. Now, there is a lot of debate about the effectiveness of this approach in the venture market, and in particular, whether the email should be a warm email, i.e. you find someone with a mutual connection and ask them to introduce you, or whether it should be a cold email, i.e. you don't have that mutual connection and you just speculatively reach out to that VC. Now, in my experience, it all depends on the VC fund and their view on which approach works best. Some VCs commit to reviewing every inbound email that they get sent, whether it's a warm or a cold introduction, whereas others definitely prioritize warm intros only, ultimately because I think they can trust those opportunities a little bit more because there is that mutual connection and the sense that the deal has been qualified a little bit before it reaches them. And the data does seem to suggest that VCs more often than not do prioritize warm introduction. I want to show you this chart from the British Business Bank that provides a really interesting view on this. As you can see, out of all of the pitch decks that reach a VC fund, 39% of them come from warm introductions, i.e. from a pre-existing relationship, whereas 50% come from cold introductions. But the second column is really what you want to be looking at. 80% of deals that get to an investment committee at a VC fund have come from a warm introduction. But the flip side to this argument is that these stats fail to consider the performance of the companies post-investment from the VC. And many people actually argue that if you rely too heavily on warm introductions, you might end up backing founders and companies that are too similar to each other, and that might impact performance. Okay, so we've covered off a few different sources of inbound deal flow for a VC. Now let's look at outbound deal flow. Now lots of VC funds pursue outbound deal flow activity, but it is particularly important for VC funds that don't yet have an established brand in the market and therefore are unlikely to have the deals coming into them. So basically, they are hustling to get access to deals. And the first way that they hustle and find deals in this way is through completing desk-based research. Now, this is what associates at VC funds spend a lot of their time doing. They are basically scanning the market, trying to proactively identify investment opportunities. And they do this in a number of different ways. Firstly, they might be researching based on that VC's investment thesis. So let's say that that VC thinks that the future of the legal or the manufacturing sector will be significantly disrupted by applications of AI. Those associates will be finding companies specifically focused on these problems and these sectors, and then they will reach out to those companies to try and build relationships. Or sometimes it's actually much broader than that, and they won't even be researching in line with the VC's investment thesis. So for example, an associate at a Series A VC fund might spend a lot of time looking at deals that have been done at seed stage, i.e. one stage earlier. That way they can get a view of what kind of companies are going to be coming down the pipeline in the next 12 to 18 months that they could consider for investment. So once the associates have found the companies that they think could be potentially interesting investment opportunities, the next step is for them to reach out to the founders of those companies to start building that relationship. Now again, they might do this outbound activity by sending out cold emails to founders and hoping that they reply, or they might look for mutual connections so that they can get a warm introduction. In my experience, warm introductions are definitely prioritized by VCs because it increases the chance that that entrepreneur is going to open the email and start a conversation with the VC investor. Okay, so another source of deal flow for VCs are events and conferences. And these can take different forms. A popular way that VCs find deal flow is through attending pitch events or demo days. This is where a group of startups come together and pitch to a room of different investors. In my experience, these events can result in mixed outcomes. Sometimes you might come across a great company that you weren't aware of before, and therefore it's a great way to generate deal flow. Whereas other times the companies might not be relevant for you, and you have to consider that even if they are relevant, there's likely going to be a ton of different investors in the audience. And therefore, if you're looking for that proprietary and unique deal flow, a pitch event is probably not the best way to find it. In addition to pitch events, VCs will attend a ton of different, more general events where they get an opportunity to network with other investors and other entrepreneurs. And these can be a great source of deal flow. Now, VCs will often look to prioritize events that are closely aligned to their investment focus areas, or where they get a chance to sell their fund before the networking begins. So a good example of this would be a VC sitting on a panel where they get a chance to talk about various topics as well as raising the profile of their fund. The final source of deal flow for VCs that I wanted to quickly talk about is publishing content. As a VC, if you're able to publish truly valuable content, it can be a great way to boost your profile in the market. And as a result of improving their profile in the market, VCs are likely to be contacted by lots of different entrepreneurs that may not have been aware of the fund before they'd read that content. On top of that, when VCs are reaching out to founders that they want to build a relationship with, sending this kind of content can be a great conversation starter and a great demonstration of the kind of insight that that VC can offer. Okay, so hopefully this video has been useful for anyone interested in how VC investors find startups to invest in. We've spoken about a number of different deal flow sources, which we've broadly categorized into outbound deal flow sources and inbound deal flow sources. Don't forget that this video only focuses on how VCs find startups, and there's a lot of activity that happens after that before a VC makes a successful investment. And I'll be making much more content on these activities. So if you're interested in this content and you enjoyed the video, please hit the like button, please hit the subscribe button, and I will see you in the next video.